Welcome back to our channel where we're discussing everything related to international business and international tax. Today we're going to dive into an important topic for Canadian employers, the tax consequences of hiring an overseas employee. So if you're considering hiring someone from abroad, we have to understand the tax implications involved. So let's get started. Before we delve into the details, let's clarify one important point. The tax consequences for hiring an overseas employee in Canada can vary depending on multiple factors, including the employee's tax residency, type of employment, any tax treaties between Canada and the employee's home country. It's always a good idea to consult a tax professional to ensure compliance with the specific requirements that apply to your situation. So first and foremost, let's talk about potential payroll tax obligations. As an employer, you're generally required to withhold and remit payroll taxes on behalf of your employees. When you hire an overseas employee, you might still have this obligation if the employee is considered a resident of Canada for tax purposes. And that determination is based on multiple factors like, are they physically present in Canada? Are they going to be physically present temporarily in Canada? Do they have ties to Canada or their country of residence? And do they have a work permit or other immigration documents? If your overseas employee is considered a Canadian resident for tax purposes, then you're going to need to deduct and remit applicable income taxes, Canada Pension Plan contributions, employment insurance premiums, just like any other Canadian employee. You're going to have to get all the information from your employee, like their social insurance number, date of birth, mailing address, to comply with all those obligations. And of course, the employee will receive a T4 at the end of the year. Now, let's talk about the tax implications for the employee. If your overseas employee is a non-resident of Canada for tax purposes, they will be subject to different rules. Non-residents are subject to Canadian tax on their Canadian source income, but tax treaties between Canada and the employee's home country can provide relief from double taxation. Common scenario is that the overseas employee will be subject to Canadian tax on their Canadian employment income, but they will claim a foreign tax credit in their home country to offset any Canadian taxes paid, which will ensure that they're not being taxed twice on that same income. But the employee has to understand the tax laws of their home country and talk to a tax professional who's familiar with their home country's tax rules to determine how their employment income from Canada will be treated in their home country. Now, there's another crucial aspect, which is withholding requirements. This is separate from payroll withholding requirements. When you're making payments to an overseas individual, you might sometimes have withholding obligations. Generally, employers are required to withhold their taxes on payments made to non-resident employees, and failure to comply with that can result in penalties and interest. Now, the final thing, however, is that it always goes back to the tax treaties between Canada and these other countries. Many countries will have a paragraph or a clause in their tax treaty that will provide exemptions or reduce rates for specific types of employment income. For example, a treaty that I was studying recently between Canada and another South American country exempted the employee from Canadian tax because the employee was fully non-resident of Canada. He was working completely remotely from his home country for a Canadian employer, and therefore was fully exempt from Canadian income tax. Therefore, the Canadian employer did not have to withhold Canadian income tax. Also, this is separate from an income tax treaty, but Canada and this South American country had a social security benefits treaty with this country, which exempted the worker from having to contribute to Canada Pension Plan. And finally, because the employee was fully non-resident, he was exempt from unemployment insurance. So the ultimate outcome for this employer was that they did not have to withhold any taxes, CPP or EI, from this employee's paycheck. So no withholdings at all, but they will have to provide the employee with a T4 listing their employment income. Because of the tax treaty, this employee is not going to be paying tax in Canada at all. they're going to be paying tax to their home country in South America on all of this income. This is a fairly typical employment clause in tax treaties and social security treaties, but every country negotiates their own tax treaty with Canada, and so it's important to review the tax treaty in detail and, of course, ideally consult with a tax professional. So finally, you can see that hiring an overseas employee can have significant tax consequences for both the employer and the employee. You have to consider the employee's tax residency, talk to the tax professional that's familiar with the tax rules in the home country, review the applicable tax and social security treaties to ensure compliance, maximize any available incentives, and avoid any penalties or unnecessary complications. So that's it. That's my video for the tax consequences of hiring an overseas employee in Canada. I hope you found this information helpful. If you have questions or you want us to cover a different topic, let us know in the comments below. Like the video, share it, subscribe to our channel. Thanks for watching. We'll see you in the next video.